Welcome back to another episode of the Lone Star Capital podcast with Rob Beardsley, CEO of Lone Star Capital. Myself, Craig McGrouther here, the Director of Business Development. And we've got a lot of fun conversations in store here today, some great topics. Let's just get right into it. We closed Cortland Med Center, now known as...
Lakes at 610.
Yes, I didn't know if it was 610 Lakes or Lakes at 610, so I wanted to make sure that before I mispronounce it, which I will many times over and over again, that you gave me the proper education there. But what a deal that one is, huh?
Yeah, there's a lot of uncertainty and volatility when you put a deal under contract and then actually close the deal. So sometimes things work in your favor, sometimes things don't work in your favor. And fortunately, I would say for the most part, things worked in our favor over the course of that escrow, and we were able to close with a better interest rate than we had projected because of treasuries coming down essentially, and Nate doing a great job negotiating on our behalf for the debt terms. So that's a big highlight.
Yeah, well, I think let's just break it down a little more detail. So we effectively got this deal locked up around, I want to say, at the end of May. I kind of look back just for historical purposes, kind of just from mental closure on these instances, but look back at the initial, deal email we send out to all of our partners and whatnot. Deal email. I don't know why that sounded so weird coming out of my mouth, but the original email that was sent out to our network and such, and that was around of end of May, and the market was actually wildly different then from even a sentiment perspective, but an interest rate perspective. So when we initially sent this deal out, I believe debt, we were penciling it to be around 6 to 6.1%. And we ended up locking in this deal at about 5.57%, which is really special. So we went from, instead of a 7-year term to a 5-year term, 5 to a 7-year. But the other kind of caveat to this deal, which, thankfully we've got, smart people on the case all the way around between you, Nate, and Kent, of course, but there's a lot of interesting legal structuring and background to this deal that made it very difficult for the, novice or the standard buyer, if you will, to kind of wrap their arms around this deal. So we had many kind of circumstances working there. We initially sent this deal out to be closed in a bridge structure, a short-term bridge, and then refinance basically the same week into agency debt, which would be very expensive on fees and just a big headache and another hurdle to sell people through on top of the tax exemption structure we fortunately got in this opportunity. So we were very fortunate to actually be able to go straight into agency debt at closing, which was a big win for us from a fee perspective, cost perspective. That's money everyone gets to save there that are with us on that deal. But on top of that, it makes the deal way less complex, which is good. But we still had to unwind the Baby REIT structure, and we still needed to close the deal, raise the money, and then also, we fortunately got into this deal where treasuries were working in our favor. So on basically every deal we've done this year, or not this year, but call it from 2023 to 2024, we have been on the wrong side of fighting the fight of treasury volatility. So effectively, if you lock up a deal and treasuries, run against you, well, now that deal is, X amount of basis points worse, not in your favor, which really hurts your cash flow, and you likely need to raise more equity on the deal. This deal was the contrary. We locked in, as I said, a 5.57% interest rate, but we were initially thinking to be around 6%. So that is massive juice right there. So on the pre-exemption, so it's post and pre-tax exemption on the cap rate, we were positive leverage by about 30 basis points on the pre-tax exemption cap rate, which is incredible. And then you splice on the exemption, we had over 150 basis points of positive leverage, meaning your cap rate is here and your interest rate is here, which is, Barry Sternlicht will say, buy positive leverage and below replacement costs in a growth market, and you're going to make a lot of money. So, we're so grateful that this, really did work out in our direction, in our favor. So everyone who got in that deal, we're very excited for you. The cool thing that I get to brag about on, and you made this comment, and we were actually chuckling about this, it was maybe the quote of the day. It was coming from Brookfield Mall when you, Brad, and I were enjoying a nice salad at maybe one of the best salad bars in the country, you could argue. And, You're like, yeah, Craig, it's very funny. You did something that would get most people fired. You were paid to not raise money on this deal. And we had a nice laugh. So essentially, we had probably could have raised about $30 million for a like deal in this one. We had to cut down everyone's kind of tranche because, as we mentioned, with debt getting better, we had to raise less money. And also the going in DSCR, debt coverage servicing ratio, was so solid that we could have even probably gone more levered, but the agencies are not comfortable with giving you more than probably 80% LTC.
Yeah, we don't need to go crazy with debt either, right? At some point, you
Yeah,
just kind of,
enough's enough.
yeah, you're at the all-you-can-eat buffet, and you're like, I'm good.
Well, if it's the Soho all you can eat buffet, I'm never good there because I go for 2-3 plates, but that's neither here nor there.
Fair enough. Yeah, no, I think those are all really important things you touched on, and you brushed over the REIT thing, which we've covered in episodes in the past. And Kent,
Well,
when he was on the show, he went in
yeah,
detail on it.
yeah, sorry to interrupt. Can you just go through the Baby REIT structure for maybe those who are not, I guess, perhaps familiar with that, who didn't listen to past episodes, just to kind of gloss over and give the cliff notes on the Baby REIT structure, why it was in place in the first place, the headaches most people have to go through, and how we were able to pull it off?
Yeah, I can recap it. So this is our second time acquiring a REIT. And what a REIT is starting from ground zero, is a real estate investment trust. And so it is it's an ownership structure to own real estate in. It's a tax focused structure. And so commonly you hear about REITs because they're often publicly traded. So a publicly traded REIT is like a stock. You can buy the stock, you can sell the stock. And the reason why companies form these real estate investment trusts is because you can actually not pay a dividend tax if you distribute 90% of the income of the properties inside, or of just the income produced of the underlying assets in the REIT. Don't quote me on all that stuff. I'm obviously not super well versed in public
But
equities,
more or less, that's what it's like.
nor in real estate investment trust tax law. But anyway, the structure, the reason why Cortland, our seller on this deal and on Preserve at Copperleaf, which we had acquired from Cortland as well back in May, the reason why they had owned both of those properties in a REIT structure is because their LP was a foreign entity. And so basically it made the most sense for the foreign investor to place funds in the US through this REIT structure, where they'd be able to, I guess, avoid double taxation, or at least minimize their tax burden in one way or another. So with that being said, Cortland made their lives a bit more difficult on the sales of these assets, because a lot of buyers shied away from the opportunity to purchase these deals, because you weren't actually purchasing real estate. You were purchasing a company, right? You were purchasing a corporation, a real estate investment trust. And for a lot of real estate buyers, that's just either too complex, or they've got other deals that they could be focusing on. And frankly, prior to us stepping in on both of these deals, they had multiple buyers try and fail. So it really isn't as easy as it sounds to purchase these REITs, because when you're buying a company, you're buying something that's more complex than just simply fee simple real estate ownership. And I would say principally the challenge is the fact that there's liabilities associated with purchasing a company, because when you buy that entity, you are stepping into the shoes of that entity, and there could be claims associated with that entity, right? Like lawsuits or outstanding bills and things like that. So you need to do extra due diligence when it comes to purchasing an entity like a REIT. And also on top of that, we have to purchase indemnity insurance. And so there's a lot of things that went into it, and it's very complex. And of course, that's why we sing Kent's praises, because he's a tax attorney, and so he's capable to handle this stuff and also recruit the best attorneys, so that we have a good team across the board that he's able to lead to be able to actually make these transactions happen. So the way that we went about these acquisitions is we purchased the REIT entity, and then after purchasing the corporation, we actually dissolve the corporation, unwind it, and then moving forward, now our ownership collapses, and we own directly the real estate, which is what we want to do, right? We don't want to own a corporation. We don't want to own a REIT. We get tax benefits associated with owning the real estate directly. That's what our investors are looking for when they partner with us. So it's very important that we structure all that. Now, what made Med Center, like you mentioned, even more complex is that not only were we purchasing the REIT, we also had the business plan of putting on a property tax exemption in partnership with the local housing authority, which is very similarly structured at like a ground lease. And I don't want to go too off in the weeds and explain a ton of stuff, but a ground lease is an ownership structure where you have one party that owns the dirt essentially and another party that owns the what's on top of the dirt, the buildings, the improvements. And this is it sounds simple, but it's a lot more complicated, especially when you have lenders involved, because now if a lender's stepping into the deal, the lender needs to understand, okay, well, what am I financing? What's my collateral? Am I financing the dirt? Am I financing the improvements? Am I financing both? And so you have to get a lender comfortable with these arcane structures. And like you mentioned, the real question mark and the real headache that we were trying to avoid with Cortland Med Center was having to do things sequentially. First, buy the REIT, and then with a bridge loan, and then unwind the REIT, get our hands on the real estate directly, direct ownership of the real estate, and then, now that we own the real estate, then bifurcate it into ground lease where the improvements are owned separately and the ground is owned separately, which then would effectuate our property tax exempt structure. Now, of course, the problem with that is doing it sequentially. You buy it on a bridge loan, you're going to have like $500,000 in closing costs and fees to do the bridge, and then you're going to have to refi quickly, pay fees and penalties going out, and the transaction costs of doing a new loan, which we had budgeted for, and the numbers still made sense, right? We had pitched the deal to investors, hey, worst case scenario, we're going to have these extra closing costs, but here are the numbers on that basis. Now, in the end, our interest rate came way down, our debt proceeds came up, we got an extra year of interest only, and we were able to avoid the extra transaction costs of doing it sequentially because we were able to do it all at once, because we were able to essentially look through the REIT and then do the structuring inside of the REIT. So that way, when we winded it up, we were left with the property tax exempt structure we were looking for all along. So going straight to agency reduces risk, reduces cost. So we're really excited about being able to pull all that off for our investors.
So the other interesting caveat that I would love to speak on here too, and to kind of give us really some praise here between you and Brad, who are really doing the negotiations with brokers and things of that nature. Not to dull Ken's light here, but how great of a team effort this deal truly was. So let's talk about the acquisition process and not being the first husband here, so to speak, and having the deal actually fall through. So do you want to maybe speak on the difference there and how lucky and fortunate we were, quite frankly, to get it there and to do a good job on the buy side? Because a group who flew in to visit us from Manhattan, very quickly, might I add, from the turnaround from me meeting with them, was very impressed by that process there. And it's just good principle. If you can buy a place for X amount less, that is X amount more dollars in your pocket effectively on the sale. And frankly, location and purchase price are the only two things you can't change in a deal. So can you spell out that process too, please?
Yeah, sure. So the best and final process on Cortland Med Center, basically, Cortland Med Center, they had awarded the deal, and then it didn't work out with the previous buyer because of, it's a volatile market right now, and the REIT structure is an added complexity. So then they restarted the marketing process, and then in this new bidding process, it came down to us and another buyer. I don't remember who the other group was, but I think they were Canadian, or they were certainly out of state. They had owned a lot of property, but they had never owned in Texas.
Yeah, no, specifically, I think they had a substantial amount of holdings in the southeastern markets. So Florida, I believe, maybe the Carolinas is the note and the detail that I recall. And they were
Yeah,
gung-ho to try to get into Texas, and specifically Houston.
yeah. So they were gung ho to get into Texas. They had claimed that they had done a Baby REIT acquisition before, So they had claimed that that wouldn't be an issue or anything like that. And like you said, they are very aggressive looking to get into the market, and they outbid us by like $2 million. And on the call with Cortland back then, I said, hey, I mean, I get it, do what you have to do, but honestly, I think that you're making a mistake, because I think we've already proven to you that we can close on this structure, because we've already bought a deal from you in the same structure, and uh, that we think we're the better choice. But of course, we stayed patient. We weren't going to just forget our numbers and go against our principles and offer more than what we felt comfortable. So we stuck to our number of 51 million at the time, and they went with the other group. The other group spent a month trying to wrap their arms around the contract. They couldn't do it. So then Cortland, a month later, came back to us and said, hey, things are looking flaky. Are you still interested in the deal? We said, yeah, we're still interested, but interest rates are a little bit higher. We're not so sure anymore. Our price is now 50. So we knocked it down $1 million, which I think was a fair thing to do. And really it wasn't just us being greedy. It was reflective of kind of our sentiment at the time and what the numbers were saying. But to your point, that that large family office that came to visit us and see the properties, they said, "Oh wow, that was actually generous of you. You didn't rip their face off. You were kind and only took $1 million off the price in your offer." And I said, "Yeah, because we're not looking to be evil or greedy. We're looking to build long-term relationships, because guess what? We're knocking on the door of, fingers crossed, working on a third deal with Cortland. So, it's much more valuable for us to be Cortland's best friend than it is for us to try to take advantage of them in a moment of weakness or something like that."
Without a doubt. And you're not trying to Sam Zell them entirely, but we still want to buy well out of principle and just say, hey, you know, please realize that, certainty with us sometimes, especially in this market, is more important than your final purchase price within reason. So I think that really speaks to that there. So very awesome by you and Brad, kind of, playing the game of chicken there, if you will, and seeing who's going to fold and bluff. But ultimately, this is the beautiful thing about real estate, which is all parties can win on a transaction. They still got a fair price in this market. It's not an easy market to sell in. We got a good price. Our investors are happy. Everyone's happy. We're doing now our 12th tax exemption structure on this opportunity, or is it 11th? I apologize. I'm blanking out on the number. It's so many.
I think 12 is coming up.
I see, exactly. Well, there's a little teaser. And I will also just note this. If you are a capital raiser or an investor, unfortunately, as many of you know, not everyone got to get into the deal from a raising dollars perspective as well as a investor perspective. So please, be a squeaky wheel and make yourself available to myself. There's several people that are kind of hounding me right now looking to get into the next deal, and I'm thinking about, frankly, pre-subscribing an opportunity before it goes live, just so we can scale up and I can kind of save everyone's spot here. And those are kind of the partners that we want to have, that are as excited for a deal as we are, and kind of know what we bring to the table and the professionalism and the quality of deal that we're going to have there. So with that said, if you are a investor, if you are a capital allocator looking to park money in an opportunity, please let me know. Reach out to me. I'm very accessible. The email, you know it, but I'll say it once more. It's Craig, CRAIG, at lscre.com. We'd love to take care of you there. But yeah, it's funny. The debt changing the deal, naturally, what it really impacts the most, and correct me if I'm wrong, is the cash flow, because the cash on cash kept on getting better and better when the rate got better. Of course, you get some juice elsewhere. The returns look better, but just to help pay down that pref accrual is really awesome.
Yeah, I'm trying to think what to say about cash flow. Better cash flow is nice.
Yeah, without a doubt. Well, I mean, getting 7% out the gates is a really nice figure. And as I spoke to all of our people on the closing call last week, they were just really happy about the entire process. So it just speaks to the team that we have and what we're building here, and kind of the types of deals that we want to do are going to be looking a little bit more like this, I would say. But then I kind of ask myself and I see what we're doing. And we've had, on an acquisition side in 2024, been pretty diverse and open-minded on what we've been doing. We've done two 2000 vintage assets, of course, the two Cortland deals. We've done a 70s deal in Dallas and an 80s deal in San Antonio. So we're really not a one-size-fits-all kind of situation here. I think that really speaks to the sophistication and the nuances that you and Brad really are looking for from a underwriting opportunity, but just to kind of create outsized returns for our investors and such. It's a really cool thing that we're not just only looking at one thing. We've got a super narrow buy box. I think there's certain things we of course inherently look for from some characteristics in every deal, but it's very fun to provide a little bit of diversity, if you will, from a investment profile, because some people look at value add and multifamily, and they're only looking for value add deals. They're so trained to only see the older product, the older workforce product, that 80s stuff that has original countertops or needs some TLC, and you're so conditioned to seeing that and wanting to fix it, as opposed to maybe what we do, which is kind of these exemption deals with newer products, which is probably a little more risk adverse. The value add is really working with us, trusting that we're buying well and trusting that we're delivering the value that we say, with the eliminating of a large bulk portion of the property taxes. So it's cool that we've got a diverse range of profiles, holding periods, and things of that nature.
Yeah, and also you don't want to be limited, and because there's times in the market where there's a better strategy that may suit the market better. So I think that's important to keep in mind as well, because the market's always changing. That's what keeps it interesting.
Without a doubt. Well, we last week, I think this will be 2 weeks from when this gets released, but 2 weeks ago we did the summit, our potentially final summit in that format, but we had our summit, which was a really special experience. I think everyone really enjoyed it.
2 weeks ago?
Well, that'll be, by the time this is out, it'll be 2 weeks
Okay,
ago.
gotcha. I feel
So
like, wow, this is so long.
yeah, yes. So would love to hear your kind of takeaway and thoughts on kind of the overall experience from start to finish. If you want to maybe recap, and I'll add in a little color if you forgot some details, but what the experience was like, the crowd, and everything like that.
It was a great turnout. We had a wonderful group of people, as always, very synergistic. It's always great to hear the feedback of people enjoying not just attending our event and hanging out with us, but getting to know other people at the event. That's a real good, I would say, piece of feedback that is great to hear. But we kicked it off with our, I guess you could call it a pre-party, but basically night one, we started at Carnegie Club, which really turned out in all ways as we had hoped. It was a very intimate
And
feeling.
more.
Yeah, and more. It was really nice. People were chatting, and it didn't feel, at least to me, it didn't feel like it dragged on or that it was forced in any way. Like, just people were just getting together. People were breaking bread, breaking the ice, which is important because the next morning everyone's kind of up early, putting their suit and tie on and getting formal and hanging out in a more formal setting, right? So the night before, being able to just have cigars, have whiskey, live jazz, and just mingle around, kind of get to see some faces and get a little familiar, and then you see them the next day and it's just a little bit smoother. So I like that a lot. And seeing people, right, it builds more trust if you interact with people in different settings, right? You meet them in this format, then you meet them here, and then you see them again. And so that just kind of really, you could build a relationship much faster rather than just like, a 60-minute Zoom call, right? That's very static. But we're going from cigars at Carnegie Club to then we're at the World Trade Center, and then we're doing panels and speed networking and small group discussions and networking breaks and lunch. And then we're at a dinner, and like you're sitting down and stuff. So it just jam packing all those different elements builds relationships really fast.
I totally agree. And it's also that kind of feeling of 7-Eleven something, 7-Eleven 4. It's just like 7 places, something amount of hours. I don't know, but Brian Spear really knocked that one out. Shout out to Brian and Sunrise Capital Group. But with that said, it was really cool to do the cigar spot first at the Carnegie Club. A different experience, but truly an experience, because a lot of people come from not from New York, not from the tri-state area, all across the country. So to kind of give someone that regal New York high end kind of, this is what you think it is of New York when you think about a New York kind of like scene, if you will. That's exactly what it was. It's a gorgeous room. They are not making rooms like that anymore. I can tell you that, with all the character and charm, from the carpeting to the bookshelves, things of that nature. And it's the funnest thing for me is sitting down and, talking to, let's say, JC Clemens and Steve Nabity and Jake Prier and Sam Morris, and everyone's kind of in a circle talking with one another. And one of my favorite quotes of the night, and it was so funny, JC, of course, always has one-liners, but said it on his equity panel. But they were talking about deals, and JC is just a deal sicko. So Steve Nabity and Jake Prier, our friends and partners from Omaha, were talking about, I think it was an office retail or some sort of like strip mall setup. And you're like, oh yeah, I was talking about this deal, asking about that deal. And I guess JC's like, yeah, do you know so-and-so spot? And Steve's like, yeah, I know that spot. I lost out on that deal. He's like, oh, I won that deal. He's like, oh, I'm so mad. I'm so mad I didn't come up and get it. He's like, hell, I'm mad I overpaid, which is just so funny. It's just the collision of all those worlds, but how just cool it was that two local experts that know Omaha like the back of their hand are with JC. That's a Houston guy with flagship institutional capital, looking at the same deals, kind of all in that spider web together. It's such a fun and organic situation that you don't get to see that and create that. So it's like these people didn't know one another, but now they have a common thread from that kind of conference and also from doing deals in the same market. So the point of that story, the moral of that story, is that the business is very small and kind of everyone knows everyone. So you better do right. You better be on your P's and Q's and have a good name, because if you don't have a good name, it's going to travel quickly. So with that said, be on your best behavior and treat everyone with dignity and respect. Of course, not that you need to hear that as the audience, and Rob and I need to hear that, but just a nice reinforced concept there.
It's a good reminder.
Yeah, but it's also fun, sitting next to Alan Steinberg, Chris Cords, and Ilya Gamer, smoking cigars and chopping it up, and having a good time and hanging out with some of the asset managers who I'm not really on the day to day with, Joe, Sawyer, and Jason, of course. Shout out to those great guys who are doing fun work. They don't necessarily do all the schmoozing, the whining and dining that, frankly, you and I get to do. Brad, of course, gets taken out because that's the flow of command, and you and I are taking people out to dinner all the time. But it's fun to have everyone come together. It's very nice to really have all the worlds collide, to see these people I've done podcasts with, that I've been pursuing, that I've been kind of talking about the event for. To have it all come together was very rewarding. It is a very draining process, though. I think the entire team probably got sick after it. I was sick for the last week. Not sick, but lost my voice and was a little bit under the weather, if you will, but recovered, feeling great now. But I also want to mention Alan Steinberg's speech. Of course, Alan with Parker Equity Group are amazing partners out of Long Island. Of course, you should have seen our podcast before with Alan, and if you haven't, you should go back and watch it, because I think it's one of the best conversations we've had on this platform. But he had a really great speech. I don't know if you want to recap it or I could kind of go through it, but I'd be curious to hear your takeaways, and I'll give you mine after.
Yeah, it was a cool speech on generational wealth, and it was a unique perspective. I thought the most unique thing that he said is, we talk about in society the negatives associated with generational poverty, where if you're born into poverty, it's upward mobility is difficult, and you don't get the same opportunities, and you're more likely for the next generation to be poor, and so on and so forth, right? It's hard to break that cycle. And the opposite for generational wealth isn't necessarily true. Like, generational wealth doesn't perpetuate itself nearly to the same degree as generational poverty, which is a really fascinating idea, because this topic is similar to another family office trope, if you will, which is from shirt sleeves to shirt sleeves in 3 generations, right? Which I
Short
think is
sleeve to
something.
long sleeve, or
Well,
short sleeve, short sleeve.
Yeah, well, because you go, the first generation is shirt sleeves, which, nothing wrong with shirt sleeves, guys, come on. But you go shirt sleeves, which is basically meaning to say the first generation came from nothing, made some of the money, and then the second generation often maybe builds on it or just kind of coasts. But then by the third generation, they've lost it all and they're back to poverty again. So it's very difficult for someone to actually, or for a family to truly create generational wealth in the true sense. I mean, that term is thrown around a lot, but to really build it and see it perpetuate across multiple generations and have future generations actually build on it and grow is incredibly rare.
Without a doubt. I also loved how he mentioned and referenced the Wolf of Wall Street. I've been a poor man and I've been a rich man, and I choose being a rich man every single time. And only the way Alan could do it with his tonality, with his mannerisms. If you know Alan or have experienced him, you know he's full of life, a absolute, I'm not gonna say character, but a personality. As you know, of course, Rob, he's got a lot of flavor and charm to him. Very charismatic, of course. Makes sense as to why he's so successful and has navigated life so well. So, thank you to him for coming. And then I guess my other takeaway is compounding your wealth in slow and steady is a very smart and valuable way to do it. And I think so often, and I'm struggling with this just like everyone else is, I'm a little bit impatient, but it was very cool to hear him preach and talk about patience and staying in the game. And, I think that he also had a thought of market timing. He's like, well, I don't know when the market's going to boom. I don't know when this or that's going to happen. But what I do know is that in 5 or 10 years from now, rents will be higher and this property will be worth more. And if it's not a good time to sell, then you just hold it a little bit longer and you wait for the market timing to sell. So hold on to your assets. Don't get uncomfortable. Don't get squirmish. Don't be in a rush to get out of any situation. Be patient. Sometimes time is your friend and on your side. And I think with real estate, time and time again, no pun intended, that will be shown.
Yeah, very true.
And then let's go to the next day. We had Shark Tank. We had equity panel, debt panel, loads of information and knowledge there. I thought the Shark panel was a lot better this year. Are those who spoke, the Placement Fund, Bryce with Cultivate, and why am I blanking out? Aspen Funds. Yes, Aspen Funds did a fantastic job. Very happy with them. I thought small group discussion was a big hit as well. Thought it was a little more formalized. I think people got a ton of value. You had a mob of people around you the entire time, you and your mom talking about asset management. We had, of course, the various other people in the room really giving some great insights. I think the amount of value from that alone, hearing how institutional people work, how, the asset management stuff worked, hearing, Ilya Gamer speak on his stuff. You had JC talk about institutional stuff as well. It was just really special to get that intimate time with people. And as you mentioned, truly get relationships built. So I thought that was a lot of fun. Did you have any kind of notes on the debt side or equity panel that you had or wanted to mention?
Just an overall thought. As the summit was unfolding, I was thinking to myself, wow, this is a lot of stuff that's happening. And the reason why I say it that way is because I had purposely cut down the amount of content for the summit because I wanted to leave a lot more space for networking. And it just, so it's actually pretty crazy because I can't remember the exact numbers, but I think we had like 10 and a half hours of programming last year. And by programming, I mean like a debt panel, equity panel, a keynote presentation,
marketing, investor relations.
Yeah, like we've done so many things on the stage and people just sitting in the chair and listening, which I think there's value there, but I felt that we had to switch it up. So I think this year we cut it down in half and it was like 5 or 6 hours that seems like too much. I think we cut it down to maybe 5 hours tops, which is still a ton because as it was unfolding, I was thinking, wow, gosh, we cut out so much stuff and we really just boiled it down to the key components and it still felt like a long day, and not in a bad way, like, oh, this is a long day, but it just was so action packed. I mean, we got through so much awesome stuff. And then after lunch, we went to the Shark Tank. I'm like, wait, what Shark Tank? There's more stuff going on. And it just kept going and going. So it was cool. I think just we nailed it just right. And I think that's something that conferences struggle a lot with. And I'm not just saying that to try to poo-poo other conferences. I'm saying that coming from a place where we've now put on 4 events, I think four conferences.
Yeah, 4. Mm-hmm.
And so as someone who puts on conferences, the thing that I struggled with and what I realize conferences struggle with is you're trying to justify your value and you're trying to make sure that people, like the last thing that I want from putting on a conference is someone who paid money to come, who flew, got a hotel, they took their precious time, and then they left feeling like it wasn't valuable, or that even worse, that they were cheated of their time and of their money. That's the last thing I want. I was actually talking to someone at the conference who came up to me and they said, "This is the most valuable conference I've ever been to. I was just in Asia and I spent $9,000 for an event, and this one is way more valuable," and so on and so forth. And I told him, I said, "That's really amazing to hear, and it's really important to me because I because we're not doing this for the money. We're not a conference business. We're not like, we don't care about your $3,000 ticket at all. Like, it's actually the scariest thing to me is charging someone that and then them thinking that it wasn't valuable. So it's something that like actually it's just very scary to me. It keeps me up at night a little bit.
Yeah, well, and I set the tone, I think, very early at the conference because you put me on blast. And basically, if you wanted to tar and feather someone because you didn't like your speed networking rounds and the dinner seating charts, I was public enemy number one. So I made it very clear, hey, please, if you are looking for someone, if you're a capital allocator looking for a sponsor, an XYZ market, let me know because I have the answers to that test. And similarly, if you are a sponsor looking for a said capital allocator, you let me know the nuance or the wrinkle as to what you're looking for, and I will do my best to put you in the right direction and give you an introduction because I, for the most part, knew all the equity people in the room. I didn't know every sponsor, but I had a rough idea as to who, what, where, why, and kind of their business model. So I really tried my hardest to kind of tether that and pair that together. Unfortunately, some people, didn't come because, last minute stuff happening, closings happening. It happened. So I did my best to alter that to the best of my ability there. And then for dinner, unfortunately, I can't control if someone departs early or not. But I think it was super important to be, I hear the vacuum in the background, super important to make sure you're providing people the value, make sure that you're providing people with what they're coming to look for because, the world is big. We're not going to raise every single dollar. We're not buying every single deal. So why not share the love around and introduce people? And then we kind of selfishly get that credit and, you'll have a positive, thought about us. As I said before, it's a perfect kind of callback to what I was saying earlier, but this industry is small. People know everyone in this business. If you're in the business for a decade here and you're going to conferences, traveling around, and you kind of have your ear to the ground, you're going to know everyone, what they're up to, what they're buying, and their business, if you will. So it's super crucial to, provide that and, be a good person in that sense. And it comes back at some point. You never know how, but it will. If you do good things will also happen to you.
Another random thought that popped into my head from earlier conversation we were having, but it's kind of related to the conference a little bit, is I'm so surprised still to this day how often we get asked, when are we expanding outside of Texas? It's like the most asked question. I don't know why, but everyone, I don't know if they want us to expand out of Texas or if they want us to change our name. Like everyone's like, "Oh, you're going to expand outside of Texas? Are you going to change your name if you do?" And I mean, we hear that all the time. And like you're saying, we can't raise every dollar, we can't buy every deal. And that's totally true. But there's definitely a question there as far as, does it make sense for us as a firm? Does it make sense for our investors to branch out and pursue other deals to give people more options? And it's not a simple yes or no because it's a give and take. Because if we do, then we're going to take away from our ability to have economies of scale and to have focus, and it'll make our lives a little bit harder.
Now, if we do it in Arizona.
Arizona would be great. It would be great for sure. But anyway, it's just an interesting thought. Like I am truly surprised as to how often we get that.
No, you're absolutely right. I think it's a compliment and a maybe not a projection, but like it would be really great if I could work with you, but in good faith, I really can't put that much more capital into another Houston deal, another Dallas deal, another San Antonio deal. The other comment I think that's why that's made is because Texas was such a darling for COVID and it also has been so good from a landlord perspective. I think a lot of people, dare I say, are overweight maybe in their Texas bucket. And that's why they're mentioning that. So they're mentioning it out of okay, well, what's around the corner for you guys? Because whatever it may or may not be, I want a part of it, is kind of how I interpret that for some people. And then some people are just naturally inquisitive because we're kind of at that point where We're very close to what, $1 billion of assets under management, kind of around that B number. When you get to the Trace Comas Club, shout out to Silicon Valley, that TV show. But once you're in the Trace Comas Club, you are to the level and to the point where maybe it does make sense to expand and to put your dollars elsewhere. So it's definitely a good thought. Where we go next is to be determined. I would likely be in an area that is probably a more of a sunshine state still, and probably an area with a little bit more consistent insurance costs and operation cost stuff. That's why Arizona, I threw that into the ring. Maybe it's a Tennessee. It might also have to do with an affordable structure. Who knows what is next, but it'll be exciting. And of course, everyone who's on this, channel and listening will be one of the first to know. Also, on that note, apologize, but Rise 48, shout out to our friends there. I was listening to Zach speak at the Hero Summit Conference, which is a solid event. Shout out to Mai. And they mentioned that they're getting into the Florida market soon. It sounds like Orlando and Tampa. So now they're in Arizona, of course. They're in Texas, Dallas specifically, the Carolinas, and then Tampa and Orlando. So, pretty cool. They've got great ambitions. They're looking to kind of buy all over. And, Zach said, with straight faced, with no doubt in his voice, and that guy's very determined, 33 and has accomplished a lot. Yeah, our goal is to be bigger than Blackstone. So I love ambition like that. Awesome guy, awesome company, of course. They do a different kind of profile than us, but it was just kind of cool to hear him, say that and kind of hear them expand. And perhaps because, some of our, I guess you could say people in our draft class, people in our, kind of starting time frame are starting to expand out of different states. You've got a lot of household syndication names, syndicator names, firm names that have left their, ultimate or first state, if you will. So that's probably why they're mentioning it. So it's kind of that life cycle where people are kind of waiting for it to happen, if you will.
I feel like we should wait until we hit 2 billion or something like that before we expand out. That's just I think we should hold out and just stay in Texas for as long as possible.
I'm happy to do whatever. And I think I mentioned this to you. So I'll mention this to, of course, our incredible audience here who's hopefully tuning in still after we've been rambling. Which is we should probably crack into the Austin market prior to leaving the Texas state. So we'll be in basically the 4 core markets of Texas, which would be Houston, Dallas, San Antonio, and then Austin. So DFW, of course, is what I mean by Dallas, but you catch the drift. So if we can get into those 4 places, we'll have great deal flow. It'll make sense. But unfortunately, the fundamentals, as we were speaking with Brad not too long ago about this, he's really trying to make San Antonio make sense. But, you can't just buy a deal to buy a deal. There are just good times to enter and exit the market. And it just makes me so happy that we're so obviously located in Houston. Houston's just performing very well right now. We're getting rent bumps. It's funny, that family office, as we alluded to from Manhattan that joined us, was very impressed to hear that we're getting rent bumps on, some of our deals, that we're not offering concessions. There's no month free TV moving in or anything like that we're able to get rent bumps. And we've been at 95% there with $0 of delinquency. So that just speaks to the Houston market and some of the assets we're holding right now. It's very exciting there.
Definitely.
On to the next topic, which is something that it's almost crazy we didn't mention this before, do an emergency podcast on this, but we've been talking about this. We knew it was coming at some point. I'm going away from the mic. We knew it was coming at some point, but the rate cut, 50 basis points. Instant reaction. I want to hear it.
Well, I want to know from everyone in the comments, where were you when you found out about the 50 basis point rate cut on September 17? I was at lunch with Rogers Gray the day after we had recorded the podcast. We went to lunch with Rogers Gray and our asset management team in Kent. And so we were just talking shop. It was a table of 9. So we had a big round table, as one does at Reserve Cut. And Joe just checked his phone and he said, Fed cut rates 50 basis points. And I had the most shocked look on my face. Jason was like, I've never seen you so happy. And I was like, I wasn't happy. I was just genuinely shocked because I really, truly did not think the Fed was going to cut 50 basis points at all, because I thought that the Fed was going to keep up their poker face and keep up kind of the idea that they're in control, that they're ahead of the data. And what essentially to me was a surprise 50 basis point cut. It wasn't a surprise cut because it was pretty much guaranteed that they were going to do something. It just was whether it was going to be 25 or 50 bips. And they went with 50 bips, which is just crazy to me because it signals that they think that the economy is in worse shape than they have been letting on, right? Uh, we go back a year, or maybe, well, I don't want to talk too much history, but basically they were saying labor market's resilient, the economy is strong, the consumer is healthy.
Fake news, folks. That it is fake news. You cannot believe that media. It's fake news. The market is bad, and if we don't get Trump in office, this economy, there might not be an economy. There might not be any
There won't be an
future.
economy.
There won't be an economy. I'm not being hyperbolic. You're being hyperbolic.
So
Sorry.
basically, for anyone
I
wondering,
had to. I had to.
investor dinners have devolved into just Craig doing Trump impersonations all night.
Yeah. The people ask for it. Sam Morris, I think, lives for it.
Yeah, everyone was asking for it. Yes,
Yeah.
of course.
Give the people what
So
they want, not what they need.
it's the opposite. You got to give them what they need. But
Sell a dream.
yeah, so the labor market, the whole time that the Fed was saying all this stuff, you and I on the podcast here have been talking about that the labor market is in fact not as strong as they claim, and that the consumer is not as healthy, and there's a lot of cracks in the economy. And I still think it's very early, and some of the data doesn't fully support this, but like hiring sentiment is very negative. So I don't want to be alarmist, but hiring sentiment, excluding COVID time, which is, you just need to take that out because obviously it was a global pandemic, but hiring sentiment hasn't been this negative as today since 2008. So people just aren't hiring, and the layoffs are coming, in my opinion, which is kind of the negative stuff I've been talking about for the past while in the podcast. And then the 50 basis point rate cut just kind of legitimizes all that because now the Fed is acknowledging it as well. And they're kind of talking out of both sides of their mouth, right? They're cutting 50 bips, which is basically signaling like, hey, we've got problems here. We need to move fast. But then their Fed speak continues to be, oh no, everything's fine. We've got a stable economy. Everything's good. But I think what we're going to see is just a precipitous decline in short rates as the Fed continues to cut.
It was what, and you asked the question, where were you when the rate cut happened? I was on the flight to H-Town, so it was very exciting there. It would have been really funny.
Was
and
everyone
fun.
on the plane clapping and going, yay?
Well, I don't know if they've got I don't know if they're as in tune as the market as, we are here, of course, but I wasn't in first class either. Perhaps in first class, everyone was popping champagne and stuff. Of course, I'm not a important enough employee to be on the first class train yet, but, at some point we'll work that into the contract. That said, it would have been a movie scene if we were all in the conference room on Monday and the rates got cut while everyone's at the conference. It would have been like a huzzah moment, a big deal. That would have just been, really incredible, considering we've got, camera gear and equipment there where we could get the live reaction to everyone talking about it. We probably have to do a little pause and send a prayer up if that in fact occurred. But it's funny, Nate Lowy, who kind of shadowed this. So Nate Lowy and Brad Waite. Nate Lowy, of course, Juniper Capital Group, shout out, and thank you so much for being the premium sponsor at our event. And then Brad Waite with Greystone, similarly, was a big sponsor too. They do a lot of deals in debt with us. So they probably love us as much as we love them for sponsoring. But that said, they were mentioning, and Nate was mentioning, guys, that the job market's not as strong. So he kind of said this, and we knew this. And then, of course, it really worked itself out when, the cut occurred.
Yeah. And we'll see what continues to happen. But like I said, I think what typically happens is the Fed ends up cutting rates faster and more than the market predicts. That's just usually how it goes. And so right now, the market is predicting that rates bottom out around 3%. I think probably towards the end of 25. So I think
3% on the Treasury, you're saying?
No, 3% on SOFR, essentially.
I see. So the other question we got, and I got more than you probably because I'm more in the weeds on talking to investors and partners, updating them with debt terms and kind of how things are going, which was we were kind of at our interest rate floor at or before the rate cut occurred. So can you explain what that means? And people ask, oh, 50 basis point rate cut. So is our debt 50 basis points better now? And the answer is A, we were at our floor. So even if that was conceptually how it worked, the answer would be no. But secondly, that was already priced into the treasury market because the yield curve before had uninverted, as we mentioned before on a couple of shows. So can you just maybe explain how that works briefly and kind of send us off on that note? We've gone 50 minutes here, so we won't bore anyone any longer.
Yeah, I think actually the 50 basis point rate cut last week from the Fed is a great use case or case study to explain the difference between short rates and long rates, or basically Fed funds, SOFR, and treasuries. So, although the Fed is made out to be this all knowing, all powerful entity, the Fed only controls the Fed funds rate, which is an overnight rate that banks can borrow from each other. And the Fed funds rate basically directly impacts SOFR. So if you're a floating rate borrower, if you have a mortgage that's the index rate is SOFR, then your mortgage is floating, which resets every month, and the Fed has a direct impact to what your mortgage rate is. Now, I would say most people, maybe not all the time, but a lot of real estate is financed with fixed rate debt of different maturities. Could be 5-year debt, 7-year debt, 10-year debt, and those loans have an index rate based on the commensurate U.S. Treasury yield. So if you're borrowing a 5-year debt term on a fixed rate, your index is likely going to be the 5-year U.S. Treasury yield, and those rates are set by the market, right? Because those are bonds traded in the open market, and people are constantly buying and selling those bonds, which then sets the yield. So the Fed can raise rates, lower rates, whatever they want to do, but the market is the market, and the market's going to trade those 5, 7, and 10-year bonds, and that's what's going to be setting the price. So there's a big disconnect there that people usually don't understand and take for granted, because they think, oh, well, the Fed lowered rates. Well, that means, like you said, my mortgage is lower. Well, actually, the funny thing about what happened on Wednesday was rates actually went up a little bit. The 5-year, the 7-year, and the 10-year went up a little bit after the Fed lowered rates by 50 basis points. So, anyone who's kind of wondering how that works, well, there's your answer, right? The Fed controls the Fed funds rate, which then controls SOFR, but they most certainly do not control treasuries. And if anything, I don't want to go kind of quasi-conspiracy theorist, but if anything, the market controls the Fed, because the Fed, people say don't fight the Fed. Well, the Fed can't fight the market forever, right? And like you alluded to the inverted yield curve, basically rates want to be lower, and they've wanted to be lower for a while now, for a few years now. But the Fed has effectively artificially propped up the front end of the curve, because the 2-year Treasury yield is essentially the market's reflection of what the market thinks SOFR, or the Fed funds rate, is going to average over the next 2 years, right? So if the market forces which influence Treasury yields, which is inflation, growth expectations, and global capital flows, if those point to lower rates, but the Fed is just keeping rates high, there's going to be that fight, and that's what's resulted in an inverted yield curve, where the long end, which is based on market dynamics and bond trading, setting lower rates, but then the Fed is keeping rates high for longer. That's how we have the inverted yield curve. And now the Fed kind of has to acknowledge that the market is in fact right. Growth expectations are lower, inflation expectations are lower, and there's a flight to quality, which means Treasury yields go down. They too need to go down and support the market as well. So anyway, that's a lot of economics kind of rolled into a 2-minute ramble, but that's the interesting dynamics of what's going on as far as the Fed lowering rates, and how that may or may not impact Treasury rates, which then may or may not impact your rate. And then furthermore, like you said, lenders with their nasty terms, they have floors, and a floor is basically the lowest that your fixed rate can go before you lock the rate. So for example, just to paint a really simple picture, you might have a loan where it's based on the 5-year US Treasury yield, which is at 3.5% today. And then you have a lender spread of 1.5%. So your rate, if you were to lock today, is 5%, because it's 3.5 plus 1.5 equals 5% all in rate. Now, what if the 5-year US Treasury yield falls very rapidly down to 3% over the next month? And then if you were able to lock, you would actually have a 4.5% rate, because you'd now be a 3% index plus 1.5% spread, and you'd have a 4.5% all-in rate. That would be amazing. However, lenders often put in a floor. So let's say the floor is at 3.25%. And what the floor means is, as rates fall, if they're falling, if you go below the floor, you basically get stopped out, and you're not going to benefit anymore from falling rates. And when you do lock your interest rate, even if treasuries are 3%, you're going to use the floor of 3.25 plus your spread of 1.5. And so you'll be at 4.75 on your all-in rate. So it's important to try to negotiate those floors in a falling rate environment, which I do believe we are in a falling rate environment. And it's tough. It's not something that usually budges, but you have to be aware of those floors.
Great Great breakdown of that. And what's funny, and the final thought is how much stocks are absolutely ripping right now. The stock market is high. So it's very interesting. I think we're in a recession, but assets have never been more expensive, really, quite frankly. So it's a very interesting market. Of course, the stock market could drop 30% overnight, 20% overnight, 10% overnight, and there could be a micro crash or correction. We're obviously in commercial real estate go through its correction over the last 18 months. I don't think it's free falling like it was before. We're already seeing cap rate compression, but cap rate compression is really a reflection upon how it'll size up with the debt. So there's still some nice positive leverage and spreads there. We're going to be in that period for maybe 18 months, hopefully, God willing, inshallah, a little bit longer. But with that said, reach out to us. This is the time to invest money in commercial real estate. Stocks are very high. Commercial real estate, alternatively, though, is very low. So from a swap swing play there, it's a good thing to long right now. I'm not saying short the stock market, but get into the alts right now, because there's a lot of disruption there. A lot of more novice, inexperienced people are losing their hats, their shirts, and probably their hair. Hopefully that won't be us on the ladder. So work with us. Reach out to me if you have any questions. For those who are listening, we appreciate you, and we'll see you next week. Peace.